Well, certainly the markets have had kind of an up and down year in 2022. Part of that can be tied to the state of the economy, the levels of inflation we've seen, the policy decisions by the Federal Reserve, and much more. What lies ahead, though, for 2023? We asked that on both sides of the question to our good friend, Professor Jeremy Siegel, Professor Emeritus at the Wharton School. Jeremy, great to talk to you again.
Happy to see you, and happy holidays to you, Dan.
Thank you very much, Jeremy. And I guess let's start out looking back at 2022. And you and I have talked a good bit over the course of the year and how the markets react. In your opinion, how have they reacted to all that has gone on?
Well, certainly it's been a disappointing year for equities. Worse for bonds, actually, relative to their historical performance. One of the few times in the past 15 or 20 years when both bonds and stocks have moved decisively lower. And the reason for that is very clear. The Fed, as we talked about a year ago, Dan, was extremely late in its tightening mode. It should have started tightening early in 2021. In fact, it didn't begin until March of this year, more than a year later than it should. Then it seemed like the Fed, which was ultra dovish, I remember on the networks, I called Jay Powell the most dovish chair of the central bank that I had ever seen. Suddenly he got religion and became ultra hawkish. At first, of course, I cheered in last November when the pivot was voiced. It didn't really start till March. It was fine. April, May, he should have started raising it faster. But then, and surprising many people in the middle of the summer, I got alarmed that Powell and the Fed were raising it too fast, because I saw a slowdown in the price increases. And I began warning that the danger now is over tightening. Nonetheless, this has been the fastest increase in the Fed funds rate that we have seen probably in the post-war period. And as every finance student at Wharton and around the world knows, financial assets are discounted at the interest rate plus a risk premium. And when the Fed sharply raises the interest rate, those valuations must go down, and they did. I attribute, therefore, most of the decline that we see to the rise in interest rates, not the fear of recession. Not that there isn't a fear of recession, there most certainly is. But if you take a look at it, it's mostly an interest rate phenomenon that has caused this decline.
In your opinion, then, if the Federal Reserve had acted earlier, might they have needed to not act as aggressively with some of the rate increases, and then maybe we would have had a little bit of a different impact along the path over the last year and a half?
Oh, most certainly, without question. If they started increasing the end of 2020 even, or beginning of 2021, we wouldn't have to go as high. We wouldn't have had the inflation that we had, and they wouldn't have to go as high as they had. And equities, in my opinion, would not have had as big a burst as they had in 2021. But we probably would have an increase in this year, a milder increase last year, and an increase in this year, had they actually started earlier.
So it feels like right now we're at a point where we've had these 75 basis point increases. It feels like December is going to probably be a little less, and then we'll wean it down in the early months of 2023. Is that your expectation? And where might the target rate end up landing, at least in the short term?
I think now we're going to get an awful lot of data, as you know, before the meeting my expectation is a 50 basis points. And honestly, Dan, I would like them to stop there and pause and look around. Truthfully, I don't even think another 50 is called for, but I think that is certainly what is in the cards at this point for the December 14th meeting. The Fed has inverted the yield curve, which of course means that they've sent short-term rates above long-term rates. That has not been a good sign in the past for economic activity. My feeling is that the vast majority of inflation is behind us. I have also voiced strongly the opinion in the media that the Fed is misreading current inflation, particularly because of the way the government collects housing statistics. They still think housing inflation is going on a very rapid rate, when in fact all the evidence on the ground is that house prices and rental prices are now declining, not rising. But because of the lagged way in which the government collects those statistics, they show they'll see the housing sector, which is a very important sector of core inflation, continue to rise throughout the rest of this year and early 2023.
What's your expectation then as we go into next year of the mindset around recession? Is it a certainty at this point? At what level might we see it? What are your thoughts?
No, it's not a certainty at this point. If the Fed continues to hike next year or stays high, I think they are going to start bringing down the Fed funds rate by mid-year. Now, some economists don't think it's going to happen until 2024, but I think that would remain tight way too long, and I think they're going to see the evidence of the slowdown once they see that unemployment rate rise, jobless claims rise, and the real economy soften. They're going to back away and start talking about decrease. That's going to really encourage the market. We all know the market turns up 4 to 5 months before the economy actually bottoms. And don't forget, this year, we had a technical recession in the first half of the year. So 2 declining quarters of GDP. Now, we had a mild increase in the third quarter. Fourth quarter looks positive. However, we don't have all the Christmas sales in yet. As we speak, we'll see how it is. But this has been a very poor year for GDP growth. I think we're going to be growing maybe only 1% this year, which is, again, normally you have recession following booms. So I don't think we may just have a period of slow growth in the first half. The Fed then lowers the rate, and then we can commence growing again in the second half of 2023.